Dollar Tree, Procter & Gamble, and Walmart are all trading at all-time highs. Dollar Tree is trading at an all-time high back to 1992. Walmart trading at its all-time high back to 1972. And Procter & Gamble, the old P&G, trading at an all-time high, dollar-adjusted, inflation-adjusted, split-adjusted, going all the way back to 1891. Good times in Cincinnati. All right, joining us now to talk more about the markets is Mark Avallone. He's president of Potomac Wealth Advisors. Do you, Mark, own any of those three stocks or a basket of consumer stocks?
Well, I don't own those individual names, but what you were talking about with the strength of the consumer is clearly evident. Those three companies have clearly defined strategies. They're executing well, and they're running a top line program. They're at the top of their game. But look, across the board, the consumer's been the engine. If you look at higher wages and wage growth year over year is over a decade at a decade high, you look at low unemployment, that gives them the bargaining power when they're looking for their next employment contract. Oil prices are in a sweet spot for those who drive to work. It puts extra money in their pocket. And lastly, this drop in interest rates puts money in their pocket from home refis, lower cost of consumer debt. When you combine all of that, they're going to go and spend money. We know Americans don't save very well. They certainly spend very well, and consumer stocks are definitely winning in that and being the beneficiary of it.
Yeah, you know, and there was a great story last night on CNBC.com by our Diane Olick, our real estate reporter. I urge everybody to go check it out and read it because it talks about how home equity has never been higher across the United States, but people are not taking that out to go buy solid gold yachts or helicopters like we did in 2006 and 2007. Maybe the consumer, Mark, has gotten smarter, and that is a positive benefit for the entire economy.
Well, that's an interesting point because consumer debt's actually a lot lower than it was in 2008. Consumers have absolutely learned the lesson of over-leveraging and over-financing. Look, if you need some money, if you want to make an extension on your home and borrow prudently, rates are lower, and that's a good opportunity. That's what I was referencing. But certainly the consumer is not over-leveraged. We hear about too much leverage. By the way, it's in the corporate sector more than it is in the consumer sector.
Oh, you see, everything was going so nice. Dow futures are up 109 points. We're feeling good. We got 1891 highs. And then you had to go and bring up, Mark, probably the most terrifying aspect of the global markets, with all due respect to Hong Kong, trade fights, and Brexit. Global corporate debt probably is that big thing, maybe the anvil or the anchor around the ankle of the markets longer term, is it not?
Well, they're feasting on these lower rates. They're almost being enticed to lock in lower rates while they can and expand with this low cost of debt. There are some other problems around the world, Brian. I don't want you just to limit yourself to those. You have the European banking crisis, and that's not looking any better. So there are pockets that do concern us, corporate debt, European financials, global instability. There are some reasons to be concerned in this market. I think that's why you see global central banks continuing to be accommodative while the Fed was measured in its comments. I don't think they're going to lower the next time out, but they certainly left the window open for that because of some of the instability and issues you referenced.